Good afternoon. The Iran ceasefire is dead. The United States struck around 80 sites overnight. Oil is up 6% and stocks are red across the board. The easy story is war scare, run to safety. Except the safest asset on earth is not being bought. 10-year Treasury yields are rising, not falling. In a real flight to safety, money floods into treasuries and yields drop. Today they went up. That is the tell of the day, and it flips the whole narrative. This is not a fear bid. It is an inflation bid. The market is not afraid of the war. It is afraid of what $78 oil does to the Federal Reserve. Let's get into it. Here's the board. Stock futures are red across the board. The S&P down 0.8%, the Nasdaq 100 down 1.3%, with chip stocks leading the drop. Now watch these two lines together. Gold, the classic panic hedge, is flat, near 41.62, and the 10-year Treasury yield is rising, near 4.48%. In a genuine war panic, gold rips and yields collapse as money hides in bonds. Today, the opposite. What is actually moving is oil. Brent up almost 6%, near $78.50 on the Strait of Hormuz supply premium. Bitcoin, meanwhile, did nothing, flat near 63,500. And overseas, South Korea's market fell into a bear market, down 5.5%, as the artificial intelligence chip trade cracked. The tape is pricing an oil-driven inflation shock, and it is saying so in the two places that cannot lie: the bond and the barbarous relic. Now the signature segment, consensus versus the read. First one, everyone thinks the Iran strike is a flight to safety event. The bond market says it is an inflation shock. If this were pure fear, 10-year yields would be falling as money hid in treasuries. They are rising. Gold, the other classic panic hedge, is flat. What is actually moving is oil, up 6%, and the hawkish tail. The read from strategist Ed Yardeni is that this rekindles the fear that rising oil forces the Federal Reserve to hike. 2 weeks ago, the market had priced that hike risk to near zero. One barrel of oil just put it back on the table. That is the real story, and almost no one is telling it. High conviction. Second read, and this is today's deep dive. Everyone thinks Nvidia is the artificial intelligence bubble. It now trades at 2019's multiple. Nvidia's forward price-to-earnings ratio is about 22 times, the same as it was in 2019, and roughly a third of its own 5-year average of 72. Goldman Sachs literally calls it compelling. Meanwhile, Korea's market just fell into a bear market on fears that artificial intelligence is overvalued. Here is the asymmetry. The fear is real, but it is mispriced onto the wrong name. The bubble, where one exists, is in the narrative and in the second-tier memory names, not in the leader's multiple. The most hated bubble stock is the cheapest it has been relative to itself in 6 years. High conviction. Third read, everyone thinks Bitcoin is digital gold in a crisis. Today it just sat there. A war headline that spiked oil 6% and rattled every equity index moved Bitcoin approximately zero. It did not spike like gold is supposed to. It did not crater like a risk asset is supposed to. It did nothing. That is not a hedge, and it is not a risk-on trade. It is an asset still searching for its identity under live stress. The read from Lynn Alden via Coin Bureau is blunt. Nothing is coming to save Bitcoin. It must stand on its own fundamentals. The crisis test everyone waited for finally arrived, and the answer was a shrug, medium-high conviction. Here is the tell, the single most revealing data point of the day. Yields rose on a war headline. Every reflex says a United States military strike on Iran should send money sprinting into 10-year treasuries and crush yields. Instead, yields went up, near 4.48%, because Brent crude jumped almost 6%. The bond market, the single hardest place to fake a signal, looked at $78 oil and decided the thing to fear is not the war. It is the inflation the war brings and the hawkish Federal Reserve that inflation summons. When the safety asset sells off during the exact event it is built for, believe the bond, not the headline. Follow the money. The regime just shifted under everyone's feet. For a month the story was soft June jobs, just 57,000, Federal Reserve on hold, maybe a cut later. Oil at 78 rewrites that. Rising yields into a geopolitical shock is the bond market pricing inflation, not recession, and it rearms a rate hike tail that had gone quiet. That makes today's Federal Reserve minutes matter more than usual. Markets want to know how twitchy the Fed still is on oil-driven inflation, and notice the market structure. Yesterday's story was a Dow record on a cyclical rotation. Today that rotation reversed hard, Dow futures down about 600 points, with chips leading the way down. In a narrow, top-heavy tape, when the artificial intelligence complex sneezes, there is nothing underneath to catch it. Two more threads the crowd is not connecting. First, the same artificial intelligence memory shortage that cracked the Korean chipmakers, down 4 to 5%, is simultaneously forcing Apple to raise prices about 20% across its lineup, according to ARK, because memory costs blew past what it will absorb. One squeeze, two victims, chip equities down, consumer hardware inflation up. Watch that as its own inflation vector, separate from oil. Second, on sentiment, our market and social monitoring shows heavy stablecoin minting this window, around 250 million in $1 token and more in another, which is fresh, dry powder building on the sidelines even as the mood splits sharply bull versus bear. Money is being loaded. It just has not chosen a direction. Sectors in play. Energy is the one sector that is green today and the cleanest expression of the shock. The Hormuz supply premium is real and live, but it sits on top of a market that was in glut 2 weeks ago, so absent an actual closure of the strait, the supply side caps the spike. Semiconductors. Nvidia at 22 times forward is a leader on sale, but the Korean bear market says the memory subsector's best case is being repriced. And the rotation is out of Korea and into China tech, not yet into United States chips. Watch whether it contaminates or stays contained. And crypto, flat through a war headline, neither hedge nor casualty. The action is in the plumbing, not the price. On the radar, today, the Federal Reserve minutes are the single most important read. How hawkish is the Fed now that oil has rearmed the inflation risk? Tonight, watch Iran. The president says he will probably hit them again, so the question is whether it stays a headline event or breaches the prediction market base case, which still gives only about a 23% chance the deal formally collapses this month. This week, watch Brent through $80. A sustained break above that line changes the Federal Reserve math. And watch whether Korea's chip crack jumps the ocean to United States semiconductors or stays a Korea rotation story. Finally, Bitcoin. A decisive move either way finally tells you whether it trades as a risk asset or a hedge in this regime. For the scorecard, 3 new calls on the record. 1. The Iran shock is an inflation event, not a safety bid, so the 10-year yield does not make a sustained move below 4.35% over the next 2 weeks while Brent holds the premium. 2. Nvidia's multiple is not the bubble. Its forward price to earnings does not re-rate above 30 times on multiple expansion this quarter. And Nvidia outperforms the second-tier memory names as the valuation fear reprices. And 3. Bitcoin is neither hedge nor risk here. Its correlation to gold stays weak, and it holds a $58,000 to $70,000 range through the geopolitical tape rather than breaking out on digital gold flows. We date them and we grade them. So here's the question worth sitting with. The whole market spent today reacting to a war. The bond market spent today reacting to a barrel of oil. When those two disagree, the barrel usually wins, because inflation, not geopolitics, is what actually moves the Federal Reserve, and the Fed is what actually moves your portfolio. So the question is not, will Iran escalate? It is the quieter one the 10-year is already asking. If a war cannot make investors buy treasuries, what exactly are they afraid of, and is it in the price yet? That's the Daily Brief. Today's deep dive is linked right below. This is Earl, one contrarian read a day. Subscribe.